Good morning, everybody. Let's give everyone a chance to finish logging into the training. Today's a very interesting topic in this environment that we're in. We're getting into the buying season for a lot of the borrowers that would probably be using down payment assistance, as we're getting a lot of people doing their tax returns. They should be getting their tax refunds pretty soon, and they're going to be looking to buy something. They're either going to buy a house, or a home. Could be a single family home, could be a condo, could be a duplex, could be a townhouse, but they're looking to buy a home, or some may end up buying a car, which is not what we want them to do. We want them to buy a home. So let's give it another minute here. I know we got people logging in, and we will get into navigating down payment assistance for loan officers. There's many down payment assistance options out there, some more restrictive than others. Some down payment assistance programs actually are for first-time home buyers only. So I'll give it another couple minutes before I start getting into it, because I know it takes a couple minutes for everyone to log in here. And those of you that are logging in today, thank you for joining us for today's training. All right, I'll give it one more minute, then we're going to go into the presentation. All right, so let's get into it. So yeah, I do thank those of you that are joining us for today's training on navigating down payment assistance for loan officers. Like I was saying, down payment assistance is interesting topic. I will call it, it's an aphrodisiac, because it's not necessarily everything. It's, in some people's mind, they have a conception of down payment assistance. But, realistically, there's many different types of programs out there for down payment assistance, right? The programs that we deal with here as a lender at the Mortgage Calculator and as a broker are the national programs, even though we are approved with conduits out there that participate in some of the state programs. So that may be possible, but participating in those state and local down payment assistance programs is very tricky, because those programs usually require a reduced compensation, right? So you have to be working at a certain comp level company-wide to be able to participate in many of those local down payment assistance programs, which makes it difficult for us as a company, because we have a company-wide comp plan. Now, we are going to be rolling out as a company where the MLOs can change to a lower margin comp plan. And in that case, you may be able to participate then in some of those programs if your comp meets the maximum comp allowable by many of those programs, which is usually 1.5 or 2% comp by the company, not by the MLO. Our margin is at 2.75, which is the reason why we're not really able to participate in a lot of these local programs that require you to work at a reduced comp. We're able to pay you, the MLOs, what we pay because of the margin that we're at, which 2.75 is pretty standard. And as a matter of fact, many lenders operate at a much higher margin than that, but we choose to stay competitive and offer the same, operate at the same margin as many broker shops do, even though we're lenders, do more work and offer more services. So let's get right into it. Thank you for those that have joined on. Navigating down payment assistance for loan officers. Now, what exactly is down payment assistance, right? So down payment assistance, I'll give you the technical definition, and then I'll break it down into the real benefit of the down payment assistance. So down payment assistance are programs that assist buyers with the required down payment and or closing costs associated with their home purchase. Now, the main benefit of a down payment assistance program, because do be aware when a loan is a down payment assistance loan, it tends to have a higher cost associated with the loan. So in essence, they're building in a little bit of the down payment assistance right into the rate. So some of you may think, what's the purpose besides the customer getting the money? Well, the main benefit is that besides obviously giving the customer the money, the down payment assistance meets the minimum down payment requirement that borrower has to put into the deal. So on a FHA deal, for example, the minimum funds that the borrower has to put into the transaction is the down payment, 3.5%. Right, that's their minimum cash contribution into the loan. And the down payment assistance will meet that requirement. So the customer does not have to show any money in the bank, any assets. I mean, unless they have to cover their closing costs, for example, then they would have to show assets to cover their closing costs. But if it's like a deal that I was structuring yesterday, borrower is able to negotiate on a $254,000 purchase, a $15,000 seller credit, which is just under 6%. I think 6% was like $15,250 or something like that. So in that scenario, even after, and I will show you this in a minute, but even after structuring it as a forgivable option, which is non-repayable, right? Which has a higher cost associated with it. We're able to structure the loan for her as with 3.5% forgivable down payment assistance, and the $15,000 from the seller is pretty much going to cover all her closing costs. So the only monies that she's going to come out of pocket basically is for the appraisal, which is an upfront expense. And that's it. I think she gave a $500 escrow deposit, which once it goes to closing, if that $500 escrow deposit isn't needed because we have DPA and then we got $15,000 seller credit, they'll return her $500 at closing. Right, so she essentially would have done the transaction with only the cost of the appraisal, which would be anywhere, probably $575 to $650, something like that, which is amazing. Now, it's not every deal that you get a seller to give, $15,000 for closing, but she was able to negotiate the deal. I think it was from a seller directly who she knows, not represented by an agent. So there was, I guess, some extra margin there for the seller to give the concession of the $15,000. But that's really the big benefit of the down payment assistance. Obviously, the quote unquote free money is the aphrodisiac that draws the borrowers in, but it's not free unless it's forgivable. If it's repayable, they got to make payments. And at some point, depending on the down payment assistance program, it may be due as a balloon mortgage. Others are fully amortizing second mortgage. Some are a balloon in 10 years. So there's multiple of the options. So I'm going to break it down a little bit more in a minute. But the down payment assistance options, I was talking about this before I got officially into the presentation here. You have locally based options, and then you have a national option. The locally based options are the ones that are very restrictive, and usually we don't directly participate in those. Now, again, we may be approved by some conduits either as a non-delegated lender or as a wholesale broker, where they have some of these locally based options, like the California one, for example. So then you would have to reach out to the account executive and discuss that option to see if there is any compensation restrictions. Because remember, our compensation, our margin is at 2.75. So even though some of our partners may offer it, where technically we may be able to offer it, but if you look into it and it says that the margin or the comp paid to the company can't be more than, for example, 1.5, then unless you are on a 1.5 margin, you can't participate in that program. That's the big catch to the locally based options, because they're usually funded by the city, the county, or state government. And as you see in the bullet points there, the locally based option requires the MLO and the company be approved to offer the program. Now, those locally based options can be combined with FHA, USDA, and first-time home buyer conventional 3% down loans. These locally based options usually are income-based. They're going to have maximum limits based on like the number of people in the household, the income of the household, which is going to be another catch there. And then, like I was mentioning, it restricts the compensation possible by the company, us, which is the biggest obstacles, as all company comp has to match. Now, the one that we can freely offer, and the one that I structured for this MLO, this borrower yesterday, and she was very excited. She was trying to force a USDA loan because she wanted to get 100% financing, but she has a co-borrower, and USDA does not allow for a non-occupant co-borrower. FHA does allow for a non-occupant co-borrower. So when I discussed that with her, I said, let's look at down payment assistance, because that looks like what you need, right? She's like, yep, that's exactly what I need, because I have seller credit, but I don't really have a lot of money for any type of a down payment. So, we structured the deal, and she's very happy, and she submitted her application, and now we're completing the pre-approval and hopefully be able to pre-approve her so then she can proceed with that contract. So the national option, which again, we offer as a company through multiple conduits that we have, does not require the MLO nor the company to be approved by the program, only that we are approved as a company by the lender that offers that DPA. The national option also does not have any income limits nor restrictions. It is not for first-time home buyers. That's another key thing. And they have repayable and non-repayable options. The non-repayable options we would refer to it really more as forgivable. So they have repayable options and forgivable options. Now, the forgivable option is the one that most people think about when they're thinking about down payment assistance, right? The quote unquote free money, because you don't have to pay that one back. But do note that the forgivable option has a higher interest rate, right? Remember, it's going to have a higher cost associated with it. Nothing is really free. It has a higher interest rate, so that may be one of the restrictions, that maybe the borrower doesn't qualify at that higher rate. But the repayable option also has a payment that needs to be made. But when you do factor out the total payment, I've usually found that the total payment on the repayable option is still usually going to be lower than the payment on the forgivable option, right? The total payment being the first mortgage plus the second mortgage that's repayable, that combined payment is usually going to be $30, $40, $50, $60 lower than the forgivable option, because usually the interest rate difference is like at least 1%. And if it's a big loan amount, that 1% is going to make a big difference in your payment. Whereas that repayable loan is usually not that much. And I'll get into that in a minute. All of the national options, you can find them in the Knowledge Center. Now, do be aware that some of these options, you have to be very careful. Some of these options may basically require borrower paid pricing, which is going to affect the borrower's cash to close, right? So some don't offer lender paid options. Now, pricing has gotten better in the last few months, so we are getting back to getting a lot of lender paid options now for these DPAs, because a few months back when pricing was horrible, it was basically borrower paid except for one option that we have. But now they're all coming in strong. And yesterday I was pricing out the 3.5% repayable option. I was pricing at 7.75, costing like 0.125 to the borrower. And I was pricing out through the same lender, because that was for an FHA deal where we are the broker. We do that via the wholesale channel. And I was pricing out the forgivable option, costing roughly 2.375. So there was like a 2.25 point in cost difference between the repayable option and the forgivable option. So if the customer doesn't want to pay that cost, they can bump up their rate. But even those options, even at the highest rate that you could charge, it's still going to have a cost. Could be 1 point, 1.25, 1.5. So it really depends. This particular one that had the 2.375 cost did not have any higher rate where we could charge less. It was 7.75, and that was the only option. But you know what? The borrower was fine with it, because that's what's going to get her into the home, right? And since she's getting the seller credit, that was making the deal possible. But do be aware that the pricing swings can be very big. So here, the national option, right? This is for purchases only, right? You can't do DPA, obviously, because there's no down payment on a refi, and you can't use the closing cost assistance option, which you're going to see in an upcoming slide, for refi, because in a refi, you're going to roll the closing costs into the new loan, unless you're doing an FHA streamline, for example, where you can only refinance the existing loan amount. Now, the national DPA options can be combined with FHA. Most of them can be combined with FHA only, but we do have one that can also be combined with USDA loans. And in that case, you would be using the down payment assistance, not for the down payment, unless the borrower wanted to make a down payment on a USDA loan. You would probably use it for the closing costs, because the DPA is 3.5%, can be used for down payment or closing costs, whichever you see fit. And like I mentioned already, there is not a first-time buyer requirement, nor income restrictions on this down payment assistance, which is what makes it amazing. It is available for U.S. citizens, permanent resident aliens, and non-permanent resident aliens. And to remind you all, what is a non-permanent resident alien? It's somebody who's legally residing in the U.S., legally, has a work permit or visa that allows them to work in the U.S., and then obviously can meet the other credit and income requirements. But that's what a non-permanent resident alien, and that individual has all the same borrowing rights as a permanent resident and a U.S. citizen. Now, a non-permanent resident alien is not an I-10 borrower, right? An I-10 borrower is not working legally in the U.S., right? They don't have a social security number. They don't have a work permit. They don't have a visa allowing them to work, but they're usually self-employed. So non-permanent resident alien is not an I-10 borrower. Now, eligible properties, I have to update the presentation because now, since we've added a few additional options, we can do up to a 4-unit with down payment assistance. Previously, it was only a 2-unit, but we can do a single family, detached or attached. We can do a PUD, which is a home that's in with a homeowners association. Planned urban development is what PUD stands for. We can do a condo as long as it is a warrantable condo, right? Fannie Mae or FHA approved. We can do a 2, 3, or 4-unit property, and we can do a single wide or a double wide manufactured home. Now there may be square footage limitations to these property types, but these are the property types that we can do. And remember, it's a 2 to 4 unit there on that. And let me change that a minute. Give me a second, and I will change that right here. Two, 4 unit property. All right, you got it right there, hot off the press. Right, so that's the national option. Now, again, I'm going to break it down a little bit further here. The national option has a forgivable option and has a repayable option. Now, the forgivable option that we have out there, minimum credit score is 620. So keep that in mind. There may be some additional requirements there. You got to get AUS approval. Also, when the credit score drops, I think below 650 or 640. So it does get a little tricky. The forgivable option offers 3.5% of the sales price to be used towards the minimum funds contribution requirement that I was talking about, the 3.5% that they got to come in to the deal, and closing costs, right? It can be used for either or both. FHA or USDA loans can be used. Now, no interest accrues. There is, I guess you'd call it, there's a second mortgage lien against a property for the amount of the forgivable DPA, but there's no payment ever and no interest ever accrues, right? And it's forgivable after 5 years, 60 payments, if the borrower is current on the first mortgage. Now, there are different forgivable options, right? Some, but they're all going to say the same thing. Basically, after 5 years, it is forgiven. Now, as I mentioned already, it does have a higher cost and rate than the repayable option, which is usually the reason to select the repayable option, right? They want the lower rate. They're not planning on refinancing anytime soon. So they'd rather get the repayable, try to work on paying that one down, and have a lower rate on the first mortgage. Now, sometimes the borrower has the money, right? But they don't have it in a manner that is documentable, like they have a bunch of cash. So they could make the down payment, but they can't just deposit the cash in the bank. It wouldn't be seasoned or sourced. So in some cases, that would be the reason to use DPA. Yeah, let's just use the DPA, use the repayable DPA, and after they close, a month or two down the road, they can just pay the DPA off with their with the money, right? And still have that lower rate. And this DPA can be combined with seller credit, like I mentioned in the deal I structured yesterday, for a true no money needed transaction. Now, in order for this loan to be forgiven, real important, it must remain owner occupied through the 60th payment. And like with all loans subject to automated underwriting, AUS, DU or LP, the maximum DTI is going to be determined by DU or LP, by automated underwriting. So this is the forgivable option, which is the aphrodisiac. This is the one that everybody thinks all DPA is. Now the repayable option, again, no income requirements, nor first-time home buyer requirements. Now, the repayable option is offered in 3.5% of the sales price or 5% of the lower of appraised value or purchase price. So you got a 3.5% DPA or 5% DPA. The 5% is cool because you can use 3.5% for the down payment, the other 1.5% for the closing costs, maybe get some seller credit, do a cashless transaction, or at least have less closing costs because you're getting some of the money for the closing costs as well. Now, this is provided as a fixed rate second mortgage, but there are different repayable options. For example, the one that goes down to a 620 through one of our conduits is a 10-year note. I mean, it's a 30-year amortization, at 9.99%, but only has a 10-year term, which means that after 10 years, it's a balloon payment. After 10 years, whatever is due, they either got to pay it off, they got to refinance. But most people have refinanced out of that loan or sold that home way before the 10 years is up when they have the repayable option and not the forgivable option. And then other options on the repayable one, like the one that goes down to 580, is the interest rate is 2% above the note rate, and it's a full term loan. I think it's a 10 or 15 year, can't recall right now, 10 or 15 year full term loan, no balloon payment. The payment is the payment. So the amortization is going to result, the shorter amortization of not being 30 years is going to result in a little bit higher payment, but it's such a small loan amount. Usually it's on a loan of 8, 10, 12,000. I mean, in an extreme case where you're talking about a real high FHA loan for an area, you could have a $15,000, $17,000 loan, but in most cases it's going to be 5, 6, 7, 8,000. So a 10 or a 30-year or a 15-year amortization isn't going to make a big difference in the payment, especially when it's helping the borrower get a home that they cannot have bought into. So this one, the minimum credit score can go down to 580, which would be another reason to have to use the repayable instead of the forgivable. If your borrower, like many out there, have a 580, 590, 600 credit score, they can't make the minimum 620 middle score, they can still participate in the repayable DPA. And this option can only be combined with FHA loans, cannot be combined with USDA loans like the other option can. So again, not eligible for cash out refi. DTI maximum is per automated underwriting, and this can be used for up to 100% of the borrower's minimum cash requirement of 3.5% for an FHA loan. So you can see how favorable this national DPA option repayable is. So in the last slide here, I bring up another option here, a lot of options going on here, which is closing cost assistance. Now, the closing cost assistance, notice here, this bullet point right here I have in black bold. If using the closing cost assistance option, the borrower must have 3.5% of their own funds to put down for the 3.5% down payment. That's the difference between closing cost assistance and down payment assistance. The closing cost assistance is again offered at the same rate as the repayable option I was just talking about that goes down to to a 620, not the one that goes to a 580, which is actually the repayable option here. Minimum is 580, but there is one that's 660 minimum, and then there's this one that's 580 minimum. The one that's 580 minimum is the one that has a full term loan. I believe it's a 15-year amortization, the interest rate 2% above the note rate. And the one that's 660 credit is the one that's a 9.99 interest rate with a 30-year amortization, but a balloon due in 10 years. Now, it's a similar setup you have here for the closing cost assistance, 9.99% fixed rate, 30-year amortization with a balloon due in 10 years. Again, no income, no first-time home buyer restrictions. This closing cost assistance has also a lower rate than the forgivable option, and in many cases also has a lower rate than the down payment assistance repayable options. In this one here, you can get 3, 4, 5, or 6% of the purchase price in closing cost assistance. So if the borrower has their 3.5% for the down and could not negotiate any seller credit, you could essentially get at least the full closing costs covered by this option. No cash back to the borrower, DTI maximum per automated underwriting, and again, minimum 660 credit score. So that is our last slide here. So I wanted to see if there are any questions regarding down payment assistance. Any procedural questions? Anybody maybe have a scenario that they were pricing out that they want to ask now? Now is your opportunity. And if not, if you guys are working quotes, remember we are in the live support Zoom room from 11 a.m. to 7 p.m. Eastern Standard Time, where you can come into the live support Zoom room and get quote assistance from one of our mentors. That's a lot better than sending an email, especially if you're learning. If you want to send an email for some basic info, that's great. But if you need assistance structuring a quote and you don't know what you're doing, take advantage of your resources, meet with a mentor, and enjoy one of the biggest benefits of being associated with the Mortgage Calculator is the live support Zoom room. So we got a question here. You mentioned that the client may have the money, but what if the funds are seasoned but are being set aside for other reasons? What could those other viable reasons be to justify using DPA instead? Well, I think you answered your own question there, Jackie. If they have money, but they really want to use it for something else, like fixing the house after closing, then if they don't mind paying a little bit higher interest rate on their FHA loan, and when using down payment, because even the repayable option, which is the one that's going to have the lowest rate, if you price out an FHA loan, right, you're going to have like probably a 1.25% difference in the interest rate between a repayable FHA loan and a regular. Like when I priced it out yesterday, it was 7.75 at costing 0.125. That same borrower could have got an FHA loan like at 6.375 at par, right? So it's about almost 1.5% difference in the interest rate. So theoretically, you could set up that borrower to get the higher rate and a little bit higher rate and get some lender credit. But most of the time, the reason that the borrower is going to use DPA, again, is to meet the minimum cash requirement of 3.5% because they don't have the money, or the money may not be seasoned. In the case of the borrower that does have it, well, then they may just not want to use it for the transaction because they don't want to have to fix the house with credit cards or real high interest rate options after closing. They really want to get it done. And again, remember, we do have FHA 203K if it's a home that needs repairs after closing. Those are a little tricky though, but that is an option out there as well. So again, viable reasons to justify using DPA really is going to be up to the borrower's needs. The interest rate is always going to be higher, but it really depends. what they need their money for. And Caprice says, does the DPA have a separate rate from the main loan? Yeah, I think I mentioned that a couple times, but I'll touch base on that again. The forgivable option does not have a rate associated with it because the forgivable option, no payment is due. There is a lien, so if the forgivable DPA amount is $9,000, there will be a lien for $9,000 for a second mortgage against a property that'll have to be paid off if the property is sold or refinanced before 5 years are up. However, after the 60th month, if the borrower still resides in the property as a primary residence and they are on time with their first mortgage, that down payment assistance lien will be forgiven. However, if it's the repayable option, then there is a separate rate, and it really depends on which option you pick. One of them is at 9.99% with a 30-year amortization with a balloon due in 10. And the other one is at an interest rate 2% higher than the rate on the first mortgage. And I can't recall now if it's a 10 or 15-year term on that loan. But it is a shorter amortization, so the payment will be a little higher, but no balloon payment. So some people may opt to go for the one that's the 30-year amortization because the payment's probably going to be $20, $30 a month lower, or 20-30% lower on that second loan, but that's going to be a very small payment. So you're looking at, let's say, the difference between paying $60 and $95 a month. But if that $35 a month takes you over the max DTI, then it makes all the difference in the world to choose that option. So again, there's multiple structure options here, depending on what is the objective. Good questions. I hope we got a few more questions because, again, this is a very important topic right now. A lot of borrowers are filing their tax returns. They should be getting their refunds pretty soon. And as soon as they get their refunds, a lot of them are looking to go house shopping because that's going to be the money they're going to use, that and possibly some down payment assistance. So after today, you all will be down payment assistance experts. All right. So, okay, I'll give it a minute to see if anyone has any more questions. I don't think so. I'll give it another minute because I know you're probably all thinking about what to ask. Don't be afraid to ask. Ask away. This is the platform for that. When you're looking at APR, the DPA cost, I'm not sure what you mean by DPA cost. If you're talking about the payment on the second mortgage, if it's a repayable option, that's a separate loan. But obviously, there is a cost which is factored into the first mortgage, right? Like I was saying, the repayable option was costing 0.125. The forgivable option was costing 2.375. So obviously, you're going to have a higher APR when using the forgivable option versus the repayable option because you're paying 2.375 points to buy down to get that rate versus 0.125. So the APR is going to be a little bit higher on the forgivable option versus the repayable option, but that's because of the cost on the rate on the first mortgage when using the forgivable option versus the repayable option. They have different pricing. And thank you, Felita. Yeah, this is a great training and definitely one that everyone wants to keep close by so that you know how to deal with down payment assistance, especially the other down payment assistance that we have available at the mortgage calculator, which is not where the buyers are not required, and I can't stress this anymore, they are not required to be first-time home buyers. very important. And there are not any maximum income limitations, nor member of the family minimum restrictions or anything like that. These are strictly loans as long as they qualify for whatever DU says. You get your auto approval, or if it's manual underwrite, you get your approval, you're good to go. There's no other restrictions in that matter. All right, so I think that we probably got all the questions we were going to have. Okay. Yeah, I know real estate agents are familiar with local options, but that is what it is, and the local options are very restrictive, and the local options are really an aphrodisiac, for borrowers, because they rush to them like flies rush into a light bulb, right? But in the end, very few of them can actually close on that loan because they're not going to get approved for it, either because they make too much money, not enough members in the family, or simply the program ran out of funding and now they may be approved as a participant in the program, but now they got to wait for the program to get funding, and then those programs also may take a little bit longer to close. I mean, like the local programs, like the bond programs, right, where you got to be like basically, at or below the poverty level, or with a very big family to be able to participate in some of those programs. Those are the ones that tend to run out of funding really fast, because those are the ones that offer you like a 20% or 30% second mortgage that you don't make a payment on, and all that kind of stuff. But again, just think about it. You would be really having to jump through hoops of fire, you and the borrower, to try to get them approved for that program. Maybe it'll work out, but the national options that we have do not have those income restrictions nor first-time homebuyer restrictions. It's just another loan. As long as they qualify for the DTI, you're good to go. And DTI and the guidelines. And that's the point that you have to stress to the borrowers when they start asking you for these localized programs that we probably cannot participate in unless you are working at a reduced comp. It would just be frustrating yourself, and you're really not missing out on a lot of opportunities. You're probably missing out on more opportunities and not having structured a few more borrowers with these DPA options, rather than fretting about the few that you may have lost out on because it was a local program that we could not participate in. I've found from my experience that there's more deals lost from an improper structure by an MLO with the options that they do have, rather than, I couldn't participate in that one option that borrower wanted. Yeah, well, follow up with that borrower and see down the road if they actually got approved for it. 9 times out of 10, I bet you they won't get approved for it. And if you would have offered them what we do have and explained to them the benefits of it, then, they may like this option, like the borrower that I structured it for yesterday. So question we have, are there any penalties when refinancing a loan that still owes DPA? No, there's no prepayment penalty to paying the DPA off. Now, what there are in some of the DPAs will allow you to subordinate the second loan, right? If they're refinancing, because that is a second loan. So whenever you have a second loan, like a HELOC or whatever, and you refinance your first loan, a subordination agreement has to be sent out to the second lien holder, where they agree to remain in second position when the new loan closes. Because what would happen in that scenario, if a subordination agreement was not signed, as soon as that first lien is paid off and you go to record a second lien, if there is not a subordination agreement, that second lien now moves up to first position, and the lien that thought it was going to be in first position is in second position. So you always need to get a subordination agreement when there is a second mortgage in place. And in some cases, the DPA do restrict the time frame that you're able to do that. right? In some cases, it's 3 years. Some cases, it's more, right? So you really would have to read the guidelines for that. And that there then is what would not allow that second mortgage to remain in place. And so in other words, if there was a restriction that you could not, that the second mortgage would not agree to subordinate for the first 3 years, that means that when the refi occurs, it's going to have to get paid off. It doesn't mean it can't be paid off. It means the opposite. It's going to have to get paid off at the closing if there is a restriction where it's not going to agree to remain in second position, or as the legal terminology goes, it's not going to agree to subordinate, is what it boils down to. Good questions, really good questions. But again, if you take anything away from this, is do not fret on the opportunities that you think that you've missed out on because you can't offer those localized programs. Do be more concerned about missing out on opportunities where you could be structuring a down payment assistance for your borrower and having them work with you instead of somebody else because you offered them something that somebody else did not offer. You know, many of those FHA buyers out there that are a little bit low on funds, as long as they got the credit and the income, then, you know, you could do DPA and then, you know, talk to their realtor to try to structure some seller credit and essentially do one of these deals like a 5% repayable DPA with a 3% of the sales price seller credit to the borrower closing. You could have a cashless transaction where the borrower only has to come up with the appraisal money. They're all gonna love that. You know, it's a lot easier to get 3% of the sale price if you're coming in at full price than it is to ask for 6% because they have no money and they're trying to structure something. So we do have a lot of options out there with the DPA. Make sure that you don't leave any money on the table by not, you know, offering all of the options that you have out there. All right, so great questions. I do thank everybody for being on today's training. Remember, we do have the mentors in the live support Zoom room from 11 a.m. Eastern Standard Time to 7 p.m. Eastern Standard Time, where you can come in at any given time and get assistance from any of the mentors on your quote structure, on any quotes you may be working on for some active leads, or on your loan structure, right? They submitted that loan application for a TBDP approval, or they're already on the contract, or it's a refi. Definitely you want to come in as soon as possible into the live support Zoom room to get assistance so that your file can be properly disclosed. So I do thank all of you for being on today's training. This is a great one. And looking forward, and myself and the other mentors are looking forward to seeing you in the live support Zoom room to assist you with your deals. Thank you and have a great day.